Everyone tells you that renting is throwing money away. But what if that common wisdom is actually a financial trap? They say you are just paying your landlord's mortgage, pouring your hard-earned money into someone else's asset. But in the economic reality of 2026, with interest rates hovering between 6 and 7%, that old cliché is not just wrong, it's financially dangerous, a myth that could lead you down a perilous path. The math has flipped, and ignoring the concept of unrecoverable costs can be a costly mistake. If you ignore these hidden expenses, you might rush into buying a home, thinking you're building wealth. But in reality, you could be lighting more money on fire than if you had simply chosen to rent. This isn't about building wealth. It's about understanding where your money truly goes. Today, I'm going to show you a specific formula that proves why paying rent might actually be the smartest investment move you can make this year. We'll dive into the numbers, redefine what throwing money away truly means, and reveal the hidden costs of homeownership. This single concept is the difference between retiring early and being house poor for 30 years. If you want to stop bleeding cash and truly understand the math of housing, make sure you're subscribed. Let's look at the numbers. Before we get into the calculator, we need to redefine what throwing money away actually means. Most people think rent is 100% waste, and a mortgage payment is 100% savings. That is the trap. The truth is, both owning and renting involve massive amounts of money that leaves your bank account and never comes back. We call these unrecoverable costs. Understanding this single concept is the difference between retiring early and being house poor for 30 years. Let's start with the phrase we've all heard at family dinners. Rent is dead money.
The logic seems sound on the surface. You pay $2,000 a month to a landlord, and at the end of the year, you have nothing to show for it but a roof over your head.
Meanwhile, your cousin who bought a house pays that same $2,000 to a bank, but he owns the place. He is building equity.
This is the logic that pressures 24-year-olds into stretching their budgets to buy literally anything, just to get on the so-called property ladder.
They are terrified that every month they rent is a month of financial failure. But here is the part your cousin doesn't mention. When you own a home, a massive chunk of your monthly payment is also thrown away. It is unrecoverable. Only narrator speaks and lip syncs. All other characters keep their mouths closed as it vanishes. First, mortgage interest. That money goes straight to the bank's profit margin, not your equity. Second, property taxes. That goes to the government. Third, maintenance and insurance. That just keeps the house standing. None of that money increases your net worth. It is the cost of doing business. In 2026, thanks to higher rates and high valuations, these owner-side unrecoverable costs have exploded. If you think losing half your payment to interest sounds bad, wait until you see what happens when rates jump from 3% to 7%. Most of the common wisdom about buying being better than renting comes from a decade of historically low rates. That world is gone. In this new environment, the math has shifted so violently that buying a house today can actually leave you poorer than renting the exact same property. To figure out if you are actually wasting money, you need a clean formula. This is where the 5% rule comes in. It is a tool used by real estate educators and financial analysts to estimate the unrecoverable cost of owning. The rule states that the annual unrecoverable cost of owning a home is roughly 5% of the property's total value. That 5% is made up of three parts: roughly 3% for the cost of capital, which is interest, 1% for property taxes. Again, these are rough numbers, but they give us a baseline. Let's apply this to a real house. Imagine a standard home priced at $430,000. Using the 5% rule, the unrecoverable home, divide that by 12, and you get about $17,792 a month. Here is the magic. If you can rent a similar house for less than $17,792 a month, renting is actually the smarter financial choice. You are throwing away less money on rent than the owner is throwing away on interest, taxes, and repairs. Even though you aren't building equity, your total financial burn rate is lower. However, we need to update this for 2026. The 5% rule assumes a moderate interest rate world. Today, with rates hovering around 6 or 7%, the cost of capital is much higher. That means the unrecoverable cost for owners might actually be closer to 6 or 7% of the home's value, especially in the first few years of the loan. If we bump that rule up to 6% on that same $430,000 house, the owner's unrecoverable cost jumps to over $2,100 a month. Suddenly, renting becomes an even better deal. The bar for wasted money has moved significantly higher. If you are visualizing this on a graph, imagine two bars. Bar A is your rent. It is purely unrecoverable. Bar B is the unrecoverable portion of homeownership. If Bar A is shorter than Bar B, you are winning. In many expensive cities right now, Bar A is significantly shorter. You might pay $2,500 in rent, but the unrecoverable costs of buying that same place, just the interest, taxes, and HOA fees, could be $3,000. That $500 gap, that is money the renter can invest, while the homeowner never sees it again. Most people stop the math there, but they are missing the silent killer of wealth: the mortgage payment. Everyone talks about the mortgage payment, but nobody budgets for the fact that houses slowly destroy themselves. If you think your rent is expensive, wait until you hear about the $20,000 roof that adds exactly zero to the resale value of your home. When we talk about maintenance, homeowners often confuse repairs with improvements. They think spending money on the house increases its value. Sometimes that is true, like if you add a bathroom. But most maintenance is defensive. It is spending money just to keep the house from falling apart. Only narrator speaks and lip syncs. All other characters keep their mouths closed, says, replacing a water heater, fixing the leak, patching the... You just avoid selling a condemned building. For a renter, these costs are zero. When the boiler breaks, it is the landlord's financial emergency, not yours. A good rule of thumb is to budget 1% of the home's value every year for maintenance. On that $430,000 house, that is $4,300 a year, or about $360 a month. That is a bill the renter doesn't pay. And that is an average. Some years it is zero. Some years it is $15,000 because the foundation cracked. This volatility is a risk that has a real economic cost.
Renters pay a fixed premium for stability. Owners take on the risk of unlimited liability.
That risk needs to be factored into the throwing money away calculation. Then, there is the opportunity cost of the down payment. This is the one almost everyone ignores. To buy that house, you probably locked up $80,000 in cash. That money is now stuck in the drywall. It is not earning 8 or 10% in the stock market. It is just sitting there. If you had kept renting and invested that $80,000 in a diversified index fund, the compound interest over 10 years could be massive. When you calculate the unrecoverable cost of owning, you have to include the lost returns on your down payment. That is money you didn't make, which is the same as money you spent. In a high-rate environment like 2026, these costs often exceed the cost of renting. It is entirely possible that you could rent isn't waste, it's just a different expense structure. But there is one more fee that destroys the buying is always better argument faster than anything else. It's the fee you pay to get out. Renters can leave with 30 days notice and a cleaned carpet. Homeowners? They have to pay a toll that can wipe out 5 years of appreciation in a single afternoon. This is why the 5-year rule exists. If you aren't staying put for at least 5 to 7 years, the transaction costs will likely eat all your profit. Renters don't pay this. They have They have called the flexibility premium, the ability to move cheaper city. If you get a job offer in another state with a 20% raise, a renter can take it immediately. A homeowner has to figure out how to sell a house in a 7% interest rate market before they can leave. That lack of mobility can cost you hundreds of thousands of dollars in lifetime career earnings. That is a hidden cost of owning that never shows up on a mortgage calculator. There is also the risk factor. When you buy a home, you are often putting the vast majority of your net worth into a single asset, in a single neighborhood, in a single city. That is the opposite of diversification. If the local industry dies or the neighborhood declines, your net worth crashes. Renters have the ability to keep their wealth diversified. They can own stocks, bonds, gold, and crypto. If the local housing market tanks, the renter just moves. The owner is trapped underwater. Paying rent is essentially paying an insurance premium against local market risks. So, stop calling rent throwing money away. Call it paying for liquidity. Call it paying for mobility. Call it paying to not worry about the plumbing. These are services you are purchasing. Just like you pay for Netflix instead of buying a library of DVDs, you are paying for housing as a service. It is a valid trade-off. The key is to make sure you are actually investing the money you save by renting. If you rent and just spend the difference on cars and vacations, then yes, you are in trouble. Now, I don't want you to think I am anti-homeownership. I'm not. I'm just anti-blind homeownership. There are times when buying absolutely crushes renting. The math favors owning when 3 things happen. First, you plan to stay in the home for a very long time, 10 years or more. This allows the transaction cost to amortize and the appreciation to compound. Second, you buy when unrecoverable owner costs are significantly lower than rent. This usually requires lower interest rates or a specific local market anomaly. And third, and this is the big one, you need forced savings. The biggest advantage of a mortgage isn't the math, it's the behavior. Most people are terrible at saving money. If they have an extra $500 a month, they spend it. A mortgage forces you to save. A portion of every payment pays down the principal, which is effectively a savings account you can't touch. Over 30 years, this forced discipline builds massive wealth for people who otherwise would have saved nothing.
If you are a disciplined investor who maxes out their 401k and IRA while renting, you can beat the homeowner.
But if you lack discipline, the mortgage might be the only way you ever build a net worth. Studies show that over a 30-year period, homeowners who stay put generally end up better off. A UK model found homeowners could save over £200,000 in housing costs compared to renters, assuming they stayed in the same spot. But notice the caveat, over 30 years. In the short term, 3, 4, or 5 years, renting often wins. The problem is that young people try to apply 30-year logic to a 3-year plan. They buy a starter home, expecting to flip it in a few years, and they get crushed by fees and interest. Buying is a marathon strategy, not a sprint. So, what is the protocol for 2026? Don't buy just because you feel peer pressure. Run the unrecoverable cost calculation. Multiply the home price by 5% or 6% if rates are high. Divide by 12. If that number is higher than your rent, relax, you are doing fine. Keep renting, keep investing the difference, and wait for the math to shift. Maybe rates will drop, or maybe rents will rise. Until then, you are not throwing money away. You are strategically waiting for the right entry point. The next time someone tells you, Renting is throwing money away? Ask them how much they paid in property taxes last year. Ask them what their roof fund looks like. If they can't answer, they are just playing house. Real estate is a numbers game, not a feelings game. Rent is the maximum you will pay for housing each month. A mortgage is the minimum. Both have unrecoverable costs. The winner is the one who keeps those costs low and invests the rest. The math is clear. In today's market, renting can be the smarter financial move. Don't let outdated advice dictate your financial future. Take control of your finances, understand the true costs, and make decisions that genuinely build your wealth. If you want to run these numbers for yourself, I've linked a few of the calculators and sources I mentioned in the description. Go check your local market. You might be surprised to find that renting is saving you thousands a year. And if you found this breakdown helpful, do me a favor and hit that like button. It costs you $0 unrecoverable dollars. Thanks for watching, and I'll see you in the next one. Remember, financial freedom comes from informed decisions, not from following outdated norms. Challenge the status quo, analyze the numbers, and choose the path that truly benefits your long-term financial well-being. Don't let emotions cloud your judgment when it comes to housing. It's a critical decision that impacts your entire financial journey. By understanding unrecoverable costs, transaction fees, and the value of flexibility, you empower yourself to make the best choice. Keep an eye on the market, stay informed, and be ready to adapt. Your financial future depends on it. This isn't about choosing sides, it's about choosing smart. And sometimes, smart means renting. So, the next time you hear the old adage, remember the math. It's a powerful tool in your financial arsenal. Don't just follow the crowd. Lead your own financial journey with confidence and clarity. And your future self will thank you for making informed, strategic decisions today. This is not about being anti-home ownership. It's about being pro-smart financial decisions. So, go forth, analyze your options, and choose the path that truly aligns with your financial goals. The power is in your hands to make the smartest investment move this year. Don't let fear or outdated advice hold you back from achieving true financial freedom. Embrace the numbers, understand the risks, and make the choice that's right for you. Your financial journey is unique, and the best path is the one you forge with knowledge and confidence. So, go ahead, run the numbers, and discover your smartest investment move for 2026. It's time to redefine what financial success truly means for you. Don't just dream of wealth. Build it with strategic, informed decisions. The path to financial freedom is clearer than you think, especially when you understand the true costs. So, go ahead, make your move, and secure your financial future. It's your money, your future, and your choice. Make it count.